Welcome, dear traders. Yesterday, stock markets were swept by a wave of sell-offs. It looked like they were gripped by panic. Investors started getting rid of shares last Friday following disappointing inflation data. Hopes for a moderate slowdown in consumer prices evaporated. This is why traders are waiting with bated breath for tomorrow's FOMC meeting. How did this statement affect the Asian trade? Let's find out. After the release of the CPI index for May in the United States, pessimism on Wall Street has only intensified. In the segments of inflation figures 8.5, 8.3 and 8.6, we can clearly see a steady rise in consumer prices from April to May. Now, investors have no illusions that the Fed is sure to hike the key rate more aggressively. Some analysts even predict a 1% rate increase tomorrow. Nevertheless, 0.50 or 0.75% rate hikes look more real. Policymakers confirmed a 0.50% rate hike some time ago, yet now there is a likelihood of a 0.75% increase as well. If the Fed raises the cash rate more aggressively than anticipated, investors will become extremely nervous. Recession fears will return, triggering a sell-off in the equity market. To some extent, it has already happened on Wall Street on Monday. And bearish sentiment is now dominating there. The NASDAQ index lost 4.7% yesterday. Along with the record drop in November, it shed more than 33%. The yield of 10-year government bonds surged as high as 3.37%, which was very close to 3.44%, the highest level since the start of the pandemic. Galloping inflation, economic slowdown and monetary tightening are dragging down not only US shares, but also Asian ones. Asian stock markets also fell sharply on Tuesday due to increased risk aversion. The US dollar enjoys high demand amid fears of the global economic downturn, and the rise in US Treasury notes, having gained more than 2% over the past 3 sessions. The US dollar eventually rose above 105 points, the highest level in the last 20 years. At the same time, the greenback also reached monthly highs against the euro, the Swiss franc, the Australian, Canadian and the New Zealand dollars. Today, the US dollar index dipped slightly versus its main rivals, consolidating in the range of 104.62 and 105.26. Only in the American session we can see whether the greenback will remain stuck in the sideways channel until the Fed's meeting or break out of it to rise higher. In the Asian session, the US dollar index was hovering at its highs. At the moment of making this video, it was trading at 104.89. Meanwhile, the dollar-yen pair plunged to a 20-year low. The weak yen has been quite beneficial for the country's import-dependent economy. For this reason, policymakers did nothing to stop its fall. Besides, the Bank of Japan, with its ultra-loose monetary policy, also pushed the national currency into the bear's claws. The yen is likely to drift lower against the backdrop of the Fed's rate hike and an increase in the purchases of government bonds by the Bank of Japan. As the gap in the yields of US and Japanese Treasury notes is widening, the yen may slide even lower against the US dollar. Yesterday, the yen managed to slightly recover after Bank of Japan Governor Hirohiko Kuroda expressed concern about excessive volatility in exchange rates. Today, Minister of Finance Shunichi Suzuki said that the central bank would take appropriate actions if necessary. And yesterday, the dollar-yen pair tested the psychologically important level of 135 and rebounded from it following Kuroda's comments. And in today's Asian session, the Japanese currency edged higher amid Suzuki's remarks. At the time of preparing material for this video, the pair decreased to the level of 134.25. And let's not forget about the yen's appeal as a safe haven currency. Although the yen is weak now, it may climb given the risk of a recession in the US economy. Today, the yen got the chance to assert strength against the US dollar, moving in the upward channel of 133.85 and 134.82. Analysts expect the pair to decline to the levels of 130 and 132 throughout 2022. Whereas the Bank of Japan maintains a dovish stance, the Reserve Bank of Australia is hawkish like the majority of central banks. The regulator has already raised the cash rate, however it may take even more aggressive measures. Presumably, the Australian currency should have advanced considerably amid a hawkish approach, as it's the case with the greenback. However, the situation is rather different for the Aussie. To start with, in the AUD-USD pair, the greenback is taking the lead. The Aussie is also sensitive to the sell-offs in the stock markets. As a commodity currency, it declines if energy prices are down. And last but not least, the Australian market is hugely dependent on China. It appears that there are now plenty of bearish factors for the Aussie. China may again reintroduce lockdowns. Oil has fallen by 0.13% today. Stock markets are gripped by panic, so traders are ditching risk assets. The US dollar is trading at monthly highs versus its rivals. Therefore, the AUD-USD pair dropped to a 4-week low, trading today at 0.6929. During the Asian session on Tuesday, the pair was moving sideways amid the consolidation of the US dollar. It was hovering between the resistance level of 0.7050 and the support level of 0.6912. And this week can be rightfully called the week of the central banks. Apart from the FOMC meeting on Wednesday, the Swiss National Bank, the Bank of England and the Bank of Japan will also hold the monetary policy meetings. Excluding the Bank of Japan, other regulators are likely to take similar steps to the Fed. If the Fed raises the key rate, they will follow suit. Subscribe to InstaForex TV channel and stay up to date with the latest market news with us. See you soon.